and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, September 1st, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Futures currently are down a bit. We finished weak at the end of the day yesterday. We are seeing futures down. Semiconductors in the news again this morning, and it wasn't good. That is certainly leading to some underperformance in the NASDAQ on a relative basis anyway. There's still some time to go before we get to the opening bell, probably still, I don't know, hour and a half, hour and 45 minutes. But right now we are seeing the Dow Jones futures down a little more than 0.25%. The S&P 500 also down about that same amount, a little more than 0.25%. But the NASDAQ's down about 0.5%. Again, a little bit of additional weakness in the semi space. In particular, NVIDIA was getting hit pretty hard this morning after the U.S. government restricted chip sales to China. So that's all playing a part there. Crude oil prices down about $1.30. So back down near $88 a barrel. It's been a pretty quick and steep drop since just a few days ago when we were up in the mid to upper 90s. The U.S. 10-year Treasury yield continues to move higher. We'll talk about that in just a little bit, but it is up 6 basis points this morning. All right, let me take you over to earningsbeats.com for those of you who are new to Earnings Beats. If you go to earningsbeats.com, scroll down, we have a free Earnings Beats Digest newsletter. It's published 3 times a week, Mondays, Wednesdays, and Fridays. Also takes the name, email address, hit that subscribe button, we'll get you set up. The articles themselves are generally very, very brief, usually just a couple of paragraphs in a chart. So if you want a little tidbit of information, it could be an individual stock that you can trade. Of course, that's your choice. But I look at these charts and talk about them based on the way we look at things at Earnings Beats. So there's a lot of focus on earnings. There's a lot of focus on the candlesticks, price volume. Those types of things are going to be really important to us. Of course, relative strength. That I think probably goes without saying for those of you who tune in here. You know, I pay a lot of attention to relative strength. But anyway, it's a great newsletter. We've had this thing now for, I don't know, maybe 2 years, 3 years. Maybe it goes back even further than that. I guess we started in 2019. Maybe it was 2018. Anyway, been doing it for quite a while. It's one way for us to give back to the community and for a way for you to check out what we do. You might pick up some things that help in your trading. You might disagree with some things, but completely up to you. Anyhow, make sure you go to earningsbeats.com, scroll down, check that out. Let's take a look at what happened on Wednesday because it wasn't very pretty. We did move lower in the morning. We kind of went sideways for a bit, but then we closed really weak on the day, again finishing, well, I shouldn't say again, but finishing on the lows similar to last Friday. So, but it wasn't an all-day selling event, but down is down. And right now the bears are in charge. And until this downtrend ends, and one way to look at a downtrend is simply lower lows and lower highs. And if you look since last Friday, that was when Fed Chief Powell gave his Jackson Hole speech, of course, talked about more pain ahead. The market didn't like it, sold off all day long. We have continued since then this week, Monday, Tuesday, and Wednesday, to put in lower lows and lower highs. So no matter how bullish you are, or if you're bullish, you still have to see this downtrend end. The downtrend, you cannot move higher until this series of lower lows and lower highs ends. The Dow Jones finished down almost 0.9% yesterday, down 280 points. The S&P 500 down to 0.8%, or 31. Clearly back down below that 4,000 level, which I was watching pretty closely, 39.55 right now. NASDAQ down 67 points, or a little bit more than 0.5%. NASDAQ did outperform the other two. Mild positive that I would take away from yesterday. Clearly, the market continues to move lower. Mid caps down 17 points, which is 0.7%. Small caps down 1%, or another 12 points. And you can see now the mid caps just barely hanging above the 50-day moving average, but all of the other major indices that I follow are back down below not just the 20-day, but now the 50-day. So definitely a much more bearish slant to the market right now in the near term. As far as sectors go, yesterday we saw communication services, the only group to the upside. it was led by internet, but much of that strength came at the open. And you can see with this black filled candle, it was selling after the opening bell. So yes, we did finish higher in communication services. It was the only group that finished higher, and we did see selling throughout much of the day. So hard to take away too much bullishness there. Materials led to the downside, down almost 1.25%, back down below its 50-day moving average, also back down below this early August low. Notice the high, the previous high, we pulled back, we broke out, we tested that low, and then took off again. Well, materials now back down below that price support area. Discretionary stocks sitting almost right on their 50-day moving average, just 50 cents above. So today could be a big day for discretionary. Technology already lost its 50-day, much of that due to the weakness that we have seen recently in semiconductors. That is not going to stop, at least not at the opening bell today, as many of the semiconductors were getting hit pretty hard this morning. But we did see discretionary down 1%, technology down almost 1%. And there's energy down 0.9%. And it's holding on to its rising 20-day moving average. But with crude oil prices down about 1.5% this morning, we're probably going to test maybe a significant test of that 20-day today. All right, moving on to the 10-year Treasury yield. So 10-year Treasury yield, I think this morning was, it's not going to show on this chart. Yeah, it's up 6 basis points to 3.19%. And I've said before, I'm watching 2 levels. I'll annotate those for you. First level I'm watching is right at about 325. And then the other is at 348. Those are going to be 2 pretty critical areas. If there's one thing that the stock market's been doing, is it's been tracking or moving inversely to interest rates. So when we really took off, we really began back the very beginning of January with this big up day in the yields, and we continue to move higher all the way through June. I mean, if you look at the S&P 500, it's almost the exact opposite. Straight down on the S&P 500 through June. Then we had the pullback in the 10-year Treasury yield, went back down below these prior lows. That coincided with a really nice move to the upside in U.S. equities. And now as the yield starts rising again, this has coincided with a lot of weakness in the stock market. So I'm not going to say it's a one-to-one inverse relationship here, because we've had rising yields before. We've had rising Fed funds rate. We've had a hawkish Fed when the market continued to rise. I sent that out to members yesterday. I don't have the charts with me, but if you look back from 2003 to 2007, that was a cyclical bull market within a secular bear market. But during those 4 years, I don't know if you recall, but we had 17 consecutive rate hikes. They were mostly small, quarter point, but we went all the way up above 5, maybe even 6%. And it wasn't until we got up to that 5-6% level that we started to sell off. The other time in history that I find very interesting is this was during a secular bull market back in the 1960s. We saw rates going up almost the entire decade. The Fed funds rate was down around 1, similar to what we started off with, before we ran into troubles this year, or within the last couple of years. But the Fed funds rate back in the 60s went from 1% up to over 5%. And throughout that decade, we had a couple of cyclical bear markets, but we remained in a secular bull and continued to move higher. So I know there's the old Wall Street adage, don't fight the Fed. And I think generally that's a pretty good thing to follow. It's kind of like go away in May. Generally speaking, I would say that's a decent statement, but it's not 100% effective. So you want to be careful, continue to watch a lot of other signals as well. But having said all that, if we look back long-term, and I'll show you the long-term chart in just a minute, but 3.25% was a really big area of resistance, at least if you just look back at the last 11 years. We went above that back in June, but it was very temporary, and we came right back down below, thought, okay, this is a head fake. Well, now we're working our way back up. Is it a head fake? I mean, we're going to find out. The Fed's having us believe that the inflation problem still is out there. They're going to remain vigilant. They're going to continue to be aggressive in hiking rates. Well, the 10-year Treasury yield, if inflation truly is a problem, this yield should be going up. We should take out that 3.48% because nobody in their right mind with inflation expectations of 5 or 6% is going to accept a 10-year Treasury yield of 3.2 or 3.4 or 3.5%. It makes no sense. So you've got to price in those inflation expectations. Just not seeing it yet, but I am recognizing the 10-year Treasury yield here moving higher. As long as it stays above that 20-day moving average and the 20 days above the 50, as long as that configuration remains in play, I think that's going to continue to put some pressure on stocks, at least in the short term. Until that changes. That's been the relationship all year. So I think we have to at least acknowledge that and respect it. All right, let's take a look at that longer term chart. I'm going to go back 15 years. And you can see right here, we were up to, I don't know, 3.5 to 4% back in here, maybe 4.5%. This is going all the way back into the secular bear market back in 2008, 2009. But since we hit that low in 2000, which was down about 1.5%, we rallied back to 3%. And then in right before the trade war began, we'd gone to 3.25%. And remember, that's when Powell famously said we're going to have rate hikes in 2019. Never did it. We actually had a rate decrease in June. I think it was June, maybe it was July of 2019. Excuse me. Just grab some water here. All right. So this is where we are right now. Clearly, this is an uptrend, but right now we had a big decline that really was exacerbated by the pandemic. So it was already a decline. We were already down even before the pandemic, or right about the time of the pandemic. We were at multi-year low on the 10-year Treasury yield. But then after the pandemic, of course, we've seen a lot of craziness in the market. One of them was the yield going down near zero, not quite getting there, but getting close. And now we've worked our way all the way back up to really the high that we've seen over the last 11 years. So will the 10-year Treasury yield break out again? I don't know. It'll be something I continue to watch. Let's move on to talking technically. I never did give you the agenda, by the way. That was my bad. But anyway, we'll move into talking technically. I'll at least give you the segments as I go into them. The S&P 500 is where I always like to start. This is what I was talking about at the open. Lower lows and lower highs. So we started this back on Friday. All this week, we've basically tried to go up in the morning and haven't been able to get there. And then we've settled down in the middle of the day and kind of finished so-so. Yesterday was weak on the finish. You can see we finished right on the low. That's never a good look. I don't like to ever see the market finish on the low. That tells me there's a really good chance that we haven't seen the low when you finish on the low, because you have to gap down in order to print any kind of reversing candle. You can't finish on the low. If you gap up, that's going to negate just about any kind of reversing candle. So when you finish on the low, expect lower prices. We are looking right now at futures that are down a bit this morning. So I would suspect, looking at the chart and trying to find the area. I mean, obviously we had this double top 3,900 just above, maybe 3,920. The low back on July 26th, that close was 3,921. That's where we gapped up from. Never really went back and filled that gap. So some of you look at gaps, might look at 3,921 as an area where we might see some support. That would be another, 34, almost 1% from where we are right now. If that area fails at 39, I think at that point, the odds of 36 come back into play. I think the odds go up rather dramatically if you don't hold 39. I think they already increased by not holding 4,000. Obviously, we're back below the 50-day moving average. You can see that daily PPO has turned back negative. I mean, we've seen that go back and forth throughout the year. But anytime it's in negative territory, at least from a shorter term perspective, it's telling us that the momentum is to the downside. So I think we have to respect that. I remain very cautiously bullish. I believe we're going back up. I don't believe we're going to break that 36 low. I don't believe we're even going to test it. But every step you take to the downside certainly increases the odds. And that's the way the way I have to approach the market right now anyway. So until we get a reversal in this trend and we see a higher high in play, the path of least resistance remains to the downside. Now here was, I've been keeping track of intraday action. I did a special show on this a few weeks ago, but I'm still tracking. Let's see if I can pull this up here. All right. Well, first, if you look at this is a 5-day, 10-minute chart. This was last Friday. So you can see the selling. This was distribution. I mean, as bullish as I want to be, I still look at this and I see nothing but selling all day long. That's bearish. No sugarcoating. That was a very, very bearish day. It's a trend day. Anytime you have a trend day where you literally just go in one direction all day long, usually you're going to have some follow through to the downside. So here we gap down, had a little bit of a rally intraday, maybe filled the gap and then came back down at the close. So early morning weakness and then rest of the day, so. And I've been looking at what's been happening after 11 o'clock. So back on Friday of last week, 11 o'clock, clearly we kept going down. After 11 o'clock on Monday, we went up, came back down. Net was a little bit positive. Here went down until about 11 o'clock. For the most part, we were just sideways after that. Here we gapped up, went back down at 11 o'clock. We were pretty much right where, until the last 5 minutes of trading, we were about even those 5 hours. But like I said, that was a very, very weak finish at the end of the day to close on the low. That would make me think that we're going to start today lower, which looks like we will. But again, these last 3 days, if you look past 11 o'clock, there hasn't been a whole lot of selling. And maybe that means nothing to some of you. To me, I look at it as manipulation. I mean, if you're selling, why wouldn't you be selling all day? It makes no sense. But our final gasp to the upside, this was back in November and December of 2021. You may not realize this, but we went from, well, let me see in the total. Let me pull the chart up here first so you know what I'm talking about. I was looking at the QQQ. And what I'm looking at is this period right here from November 19th to here, or maybe it was the first, let's see, what day was it? It was the close of that first day it's right here. So if you look at that close, we closed at 400.41. And over here, we were at 402.20. So the net, we were down a couple bucks during this period. Let me tell you what we did during this period. We had and this is just breaking down the period by times of the day. Opening gaps during this period right here. Now, remember, we only went down $2 for the day, or excuse me, for the period. We were up $6 at opening gaps. So it was almost like, we had been going higher. The market was telling us, hey, it's going to keep going higher. We're gapping up throughout this period. The first 30 minutes of trading, we went up another $2. So actually, we were up about $8.50 between the opening gap and the first half hour of the day. But the balance of the day, we went down $11, $10 or $11. So that was a chance for Wall Street, in my opinion, to begin offloading some of the stocks that they were offloading, many of the technology, consumer discretionary. That's where a lot of the selling, in my opinion, took place. And then, of course, massive distribution. That period during January, we saw selling throughout the day. There was no let up. Balance of the day, afternoons, selling all day long. during the next rally phase, which I identified as actually the distribution phase that I identified was January all the way down through May. And then from May 23rd to June 17th, here to here, is what I considered manipulation phase. Manipulation phase, opening gaps were down $25 net. After 11 a.m. was up $25 net. No one will ever convince me there wasn't manipulation taking place there before we started to see the market rally. And during this rally, by the way, the afternoons from 11 a.m. to the end of the day, we went up $26. The rest of the time, gaps, everything else, we went up another 28, or maybe it was 30. Let me see, 20, 35, about 32. So we went up $58 during the recovery phase. Here to here, actually the total, yeah, well, it's going to be from a closing basis. So probably we went up about 61. And I'm showing 35, roughly about 32 or 33 was gaps through 11 a.m. 26 of it, though, was after 11 a.m. So we continued to see that buying during this period right here from the high on there's the June 17th low. Okay, so the high on August 15th, that was, by the way, week of options expiration, which showed a lot of in-the-money call premium. Anyway, from there down, we have lost $34 through yesterday's close. Do you know how much has been lost in the afternoon from 11 a.m. to 4 p.m.? Of that $34, $2 has been lost in the afternoon. $10 has been gap downs. And then the other $22 has been from 9:30 to 11 in the morning. Now, again, we're going lower. Prices are going down. If you're looking at your portfolio and you're invested, it doesn't mean that you're not really losing money. You are losing money. So I'm not trying to mitigate that. What I'm saying, though, is that it's not acting here like it did here. And whether or not that proves to be significant or not, I don't know. I'm just reporting what I see, doing the analysis. I think it's meaningful, but until we get a reversal on the market, it's not meaningful. I would respect this downtrend until it reverses. All right. I wanted to go over, so the next segment, which I didn't give you earlier, is hot seat. So I'm going to give you the group that I think is on the hot seat right now. And this is will be no shocker to anyone who's been following the stock market. But to me, it's the semiconductors. I mean, this group is clearly on the hot seat. And I'm going to just pull up real quick. Pre-market, NVIDIA was getting hit pretty good earlier. I mean, it's down $6 to 145. So if we go back and we look at this chart and switch over to NVIDIA. So here we are, but we're getting down close. We're getting down close to this July low. 145. I've said all along that if there's one thing that has remained in the bearish camp throughout this entire period, it's been the semiconductors. They've shown us very little in terms of absolute strength. If you look, most areas of the market during the rally went back up and took out that the early June high. You can see NVIDIA didn't. If we pull up the semiconductors, they didn't. Could not get through the June high. Now we're rolling back over. So on a relative basis, if we look at what's going on, I mean, we remain in a downtrend. It's hard to argue. If somebody says, hey, how can you be bullish? The semiconductors are weak. I would say, well, based on that chart, I would have to agree with you. Semiconductors are weak. For me, the market's a big puzzle. This is one piece. It's a piece that I'd really like to see bullish. It's not. We all have our biases for whatever reason. And if your bias is bearish, this is certainly one of the charts I'd be pointing to. This has been a horrible year for semiconductors, and it continues to be. And remember, this is on a relative basis. So we know the market's been going down. Semiconductors have been going down faster than the market. That's why I think this group remains on the hot seat. I do want to talk sentiment for a minute, because I don't know if you've been paying attention. I pay attention to this every day. But the 5-day moving average of the equity-only put-call ratio has been on a roll to the upside. One of the things I'd been pointing out, I don't recall here, but I know to members, was when we were moving lower, we had to be careful because we were turning very, very bullish, or at least more bullish. We had to be careful when this 5-day moving average really began to turn back to the upside. And that occurred mid-month. That occurred right when we topped. It occurred when the equity-only put-call ratio had dropped all the way down here to 0.54. I mean, I'm not making this up. Here was the bottom. Look at where the market top came in. This is the S&P 500. So when you get these major bottoms after declining for a while, here's one. Here's a big one in March, this huge decline. I mean, it's almost right on cue. This huge decline, market didn't really drop a lot, but that was a pretty significant top. We didn't go higher for a while. These are all things that you've got to watch. Now, on the flip side, when you get these big moves up in the 5-day moving average of the equity-only put-call ratio, you got to realize that you're probably getting closer and closer to at least a short-term bottom. Even those of you who believe we're going lower, going to take out the June low, I would still I'd be getting nervous a little bit right now because of this movement right here in the 5-day moving average. Maybe you think it's going to go up above the 0.825. I can tell you that throughout this century, 0.75 to 0.80, we've seen a lot of major turns when the 5-day moving average gets there. And I would say probably today, if we're weak, we're probably going to finish with this 5-day moving average moving above 0.75. Just food for thought. All right, earnings real quick. Veeva Systems came out, reported yesterday. The numbers actually were pretty good on a number of companies. If we look at the actual pre-market action, Veeva Systems down $22. They beat, bottom line, 103 versus 101. MDB down $53. They beat 23 cents loss versus 29-cent loss expected. OKTA, Okta reported down $17. These are three, mid-cap software companies that I think are pretty important to the software space. All three beat estimates and all three getting crushed in pre-market. So let's take a look at those three charts just to wrap things up here. So this will be your three you must see. So here's Veeva. I mean, if I look down here, I see some support, maybe down at this gap support right below 170. Top of gap support, 178 or so, 177. That's an area I would be watching for. Maybe we reverse off of it, maybe not. MDB, also with the big move down. I mean, as I look down here, probably, I'm going to say this area, 260 to maybe 265. I think that's the area I'd be watching on that one. And the last one is Okta, OKTA. And here I would just be looking at this double bottom, which it looks like we're going to open below. Let's get a look and see what that lowest candle body is. 78.77, 78.43. 78.43 is what I'd be watching on the open. And it looks like, yeah, we're below that right now. So it looks like Okta is going to open below support. Anyway, that's all I have for you today. I appreciate everybody tuning in. Have a great rest of your day. I'll be back on Monday over at Earnings Beats for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.